how exciting it is. Ooh, not for natural gas though, having a bad day. NASDAQ. All right, all good, thank you. All right, let's see. All right, so as you can see, we are weakening a bit. This is today. So we started out here, had a bad time until 11, started having a good time. Now we're fading a little bit again. And that's the S&P. That's the NASDAQ, kind of the same story. That is the Dow. Nobody cares what the Dow does. The Dow is just a silly, silly index. RTY. Yep, there's the Russell. And the Russell also having a pretty bad day on the whole. I mean, you know, it says it's up a point, but this is not the way you want to be up a point. Like, you know, here, we can magnify this a bit. Ugh, never right. Oh, well, anyway. So here's pre-market, then we go down, then we go way down, and now we're barely recovering and down again. So this is not looking good. And again, what I was talking about this morning, we're going to go over that in more detail, but it's the volume that matters. So here's the volume, 930, right? No volume. There's no volume here. This is just nonsense. You know, what happens pre-market doesn't matter. But there was a spike of volume that took the Russell higher, significantly higher. It didn't hold up for long. Then they were selling that equals the spike. Then when the market opens, there's another big spike of volume. This is all of these fakers taking their money back out. They only want to do is jack it up, and then they take the money back out. Then selling. You have to add up all of these selling candles, or bars, I guess. You have to add up all of these selling bars together, which would be a bar this high, and then measure it against the buying bars, which is here and here and one here and a couple over here. And then you would say, well, gee, there was much more selling than buying in volume. Therefore, bad day. It's, you know, where it ends up is not indicative. And we'll get back into that because I had a whole conversation about it in the chat this morning. So there we are. So anyway, not that exciting is the takeaway for where we are at the moment. And let's take a look at the futures. Give you a similar story. Okay, I mean, obviously on daily view, it's a big nothing. You know, and I know it's funny because I mean, I'm aware that the NASDAQ is up 300 points. But when you got to put it in perspective, 300 points against this kind of drop is nothing. It doesn't matter that it's up 300 points. Poor Nikkei is down 20%. That's 20. This is a 20% drop for the Nikkei. 40,000 to 36,000 is a 20% drop. They're also in big trouble. How's the yen looking? There's the yen. That's not so. I mean, the yen is improving, which is obviously not good for the market. So the yen goes from 64 to 68. That's 4 out of 64 is more than 5%. I mean, right? Because what's 4 into 64? I don't know. I can't do math anymore. It's not that I can't do math. I don't trust myself to do math. I make more mistakes than I used to. I used to never make a mistake, so now I'm always worried. It's like I'm going to say something stupid. So 6.25%. So you have a 6.25% bump in the currency, and the index gets clobbered because it's priced in yen. Look at us though. Whoa. Oh, 103.08. Oh my God. So our currency, meanwhile, is going to hell in a handbasket. From 110 to 103 is 7. It's the same as the Nikkei, really. It's 7 divided by 108. Oh, no, 110, I said. 110 is 6.3%. So it's basically the same as the Nikkei went up. So our currency is becoming worthless, and that's putting upward pressure on the market. So when you see the market now, you have to imagine it's much worse than it looks, because the dollar is devaluing at the same time as the stock prices are falling. So in other words, in December, you could buy Apple for $260 good dollars. So let's say 260 times 1.1. So the dollar was 110 there. So that's like 286. Okay, that's what we've fallen from. So if you constant the currency, we're down from 286 to 217, because 217 is the dollar at the current price. And that's $69 divided by 286 is 25%. So it doesn't look like it, but when you think about the currency change, these dollars were worth 110. The dollars they're offering you now are only worth 103. So if we do it the other way, it's going to be the same thing, but it's 217 times 1.03. So it's 223, well, in constant currency. So it's really 286 minus 223. Sorry, so it's not as bad. It's 286 that was offered over here, and here it's minus 223. So it's 63 down from 286 is 22%, not 25%. All right, because we're not using 100, because this isn't 100, this is 103. We're not using 100 base. So here it's 110, and that brings us up to 286 because you had better dollars. It's 286 in these dollars, and here it still has 3 more than 100, so it's 223. But the point is, worse than it looks is the thing, and that's how the whole index is. It's all worse than it looks. And the problem with it being worse than it looks means eventually it'll look correct. It's not going to constantly be an illusion. At some point, the dollar will equal out and the equities will get downward pressure. And again, this is why we cashed out last week, not all, but we 50% cashed out and added a lot of hedges. And the reason we did that is because that was a whole other thing on top of every other problem that we have that was driving the markets lower. The problem was, if things got better and the dollar improved, that would then put pressure on the markets to go down. So there's almost no real good path to us improving this week. So what was the point of staying long when there is a risk of a tremendous collapse? And that's exactly what happened on Mondays. We had a tremendous collapse. So if we go to an hourly chart, so on Friday, we had hedges for 10%, so this was nothing so far. And on Friday, though, what if we have another 10% decline was the question. And I said, well, you know what, we could go into a really rapid decline next week, and much more so than this. This was not a rapid decline. It wasn't a pleasant decline, but it just consistently going down a bit every day. And I was worried on Friday, which was the 7th. My concern was that we would head into a more rapid declining leg because there were so many freaking things that could go wrong. And Trump is sticking to this tariff thing, which is a complete disaster. So therefore, on Friday, I said, you know what, there's 2 things we can do. We can add more hedges. We added more hedges, and we can cut our longs. So we took away all the long positions that we did not want to, that we weren't thrilled to put more money into, basically. All right, and that's how we came up with our list on Friday. And let's take a look at that, just to be, since we didn't do this at the last webinar, did we? So, oh, What day is this? This is Friday's post, isn't it? No, that's Wednesday's post. So on Thursday, try to do things in some sort of order. So on Thursday last week, so here is my issue on Thursday. And I don't randomly write headlines. I mean it when I write a headline. So the Supreme Court showed the world Trump is in charge. The courts and Republicans approve, and the Democrats are helpless. That was from the State of the Union address, right? Yeah. So not the Supreme Court. Sorry. The state. I was thinking of SCOTUS. The State of the Union showed that Trump is in charge. The courts and the Supreme Court was there, and the Republicans were approving, obviously cheering madly, and the Democrats were holding up paddles. I mean, there's nothing they can do. There is no resistance is futile. I won't say there is no resistance, but the resistance is pointless. What are they supposed to do? They can't do anything. They don't have the votes. The Democrats have been voted completely out of power, and the Republicans have given all of their power to Donald Trump. When he was president the first time, there were Republicans he had to get to agree with his crazy stuff. People like Mitt Romney and things like that and the one that died, McCain, there were people who were against him and who said, yeah, okay, we're generally in favor of these kind of programs, but you're going too far here, you're going too far there. There's no one like that now. The Speaker of the House was sitting behind Donald Trump at the State of the Union, applauding like a freaking trained seal. Remember when it was Nancy Pelosi's job to sit there frowning with a frowny face and not clap or stand up for anything Trump did? That's gone. There's no resistance. And not only that, but the Supreme Court has granted him powers that are beyond extreme. The president now has all of the power, and no matter what he does, it's not illegal. So he can push the envelope as far as he wants, and it will not be considered illegal. They've given him a complete pass. I mean, literally, not figuratively, literally, anything he does in office that he is able to justify as an action taken on behalf of the United States, he cannot be prosecuted for. And as far as we can tell, that includes murdering people. If he murders people and figures out a way to say that it was in the best interest of the country to kill that person, as long as it's arguably it doesn't have to be even correct. It has to be arguably that he reasonably had that assumption, they can't prosecute him for it because it was a presidential act. That's where we are now. And he's only just starting to flex those muscles. So anyway, so if you voted for him, yay. That's what he's getting. That's what he gets to do now. So anyway, so this was my problem on Thursday. And I said last week the dollar was 107.50. Now it's testing 104. And that's bad, blah, blah, blah. The tariffs are and then the thing is, when I say something like it's the tariffs, this is a week ago. It sounded nuts, but we kind of thought he wasn't going to actually do all this stuff. But then it started to become clear that he intended to actually do these things. And I said a day after doing it, he gave a 1-month exemption. And the pattern of aggressive threats followed by unexpected pauses becomes characteristic of the approach, which creates an environment where allies and markets remain perpetually uncertain about. I mean, this is all sounds like, oh yeah, of course, this was a week ago. We weren't so sure this was going to be the whole thing, but this is insane. And it's getting worse and worse. And so the thing is that by Thursday, I was like, you know what, this is happening. This is real. And at the time, we were still over the 200-day moving average. We were over the week retrace because, a week retrace, we didn't panic here. We had no panic here. We were buying when it came down here, but things changed. The fundamentals that create these support levels were falling apart. And we had what would be technically an oversold RSI. It seemed like we should be bouncing. We hit the resistance, we bounced off that. Everything seemed pretty good on Thursday. But I just didn't like the way it looked going into the next week. I'm like, if this stuff happens and they keep going in this direction, then things are going to really hit the fan. And we talked about the CPI and what was happening with the CPI, which we had a better report than expected today. But we were very concerned about that being inflationary. And I was talking a lot about the dollar here and what the weakening dollar means and how it hurts your buying power and so on and so forth. I mean, a weaker dollar, when the dollar goes from 110 to 104, then everything you own, it's not an income tax, it's a wealth tax. It's on a tax on everything that you own. Because if you sell your home and you're going to get dollars for it, then you're getting dollars that are worth 6% less than they were. If you've got $1 million in the bank, then the buying power of your $1 million is down $60,000, 6%. That's just a simple fact. The buying power of the dollars that you measure your wealth in has decreased by 6%. That's as if you got a 6% wealth tax. Now, the Democrats were only talking the Democrats were only talking about a 2% wealth tax, and everybody freaked out. And that's because they were honest about it, and they weren't going to cause inflation, and they weren't going to do all these whacked out tariff things and piss everybody off. They were just going to say to everybody in America, you know what, we need 2% of the money of the people who have more than $1 million. It was a very honest way of taking 2%. This is a dishonest way of taking 6%, and there's no minimum. You're taking 6% from every single person in America who has any kind of money. It's much, much worse than what the Democrats proposed. But people, it's the same problem Southwest has. And the reason Southwest had to stop having no baggage fees is because in study after study after study, people can't do the math. They see a Southwest airfare to Florida for $300 that includes bags, and then they see a Delta airfare for $250 that doesn't include bags and charges you $50 each way. So the Delta flight ends up costing you $350, and the Southwest flight ends up costing you $300 because they were honest about the price up front. But you know what was happening? Everybody was taking Delta, and Southwest was losing market share to the other airlines because they seemed to have lower prices. And because when you search in the travel systems, which is how everybody gets a flight now, right? Everybody goes to booking.com or Priceline or Travelocity. When you go to the search service and you say, what's the cheapest flight to Florida? It doesn't tell you that Southwest is cheaper because if you do the math, it works out better and blah, blah, blah. That doesn't happen. It tells you here's the cheapest airline. And even worse, and Southwest is doing this now, they have this incredible bullshit thing called Economy Plus. And Economy Plus means I don't even know if you can have a carry-on with Economy Plus. I don't even think you're allowed to carry on. But Economy Plus also doesn't give you an assigned seat. So basically, you're getting, they're basically saying you're getting the middle seat. But that comes up as the cheapest fare, even though, you'd rather kill yourself than go on Economy Plus. That comes up as the cheapest fare. Well, I guess if you're skinny, it's not so bad, but it's like, for me, I'm a big guy. That's not going to happen. I am not flying in the middle seat. Any trip at all, I don't want to be in the middle seat, but any trip over 2.5 hours to Florida, because for one thing, even when you go into Florida, you can be in the seat for 6 hours. You never know what's going to happen. You can be on a 2.5 hour flight and be in the seat for 6 hours because of delays or problems on the runway or whatever, so it can be a nightmare. But if I'm planning to fly to California, there's no chance in the world that I'm going to get in a seat in the middle and sit there squished up for 6 hours. That's just insane. And that 6 hours could turn into 10. Anyway, so point being though, that and this is being found, and this is why there's so many hidden fees. Remember, Biden was wanting to eliminate all these hidden fees and stuff, and the Republicans kept blocking it. But this was Biden's quest, was to stop this hidden fee bullshit that's creeping into society. But the reason it creeps into society is the same reason that you don't understand, and not you, of course, you guys are very intelligent, but the you public. Of course, not you guys, but the general public, who are much dumber than we are. The reason that the majority of the people respond to that is because they don't do the math. They even if you know it, even if somebody explains it to you, it's very hard to keep it in your head when you're looking and comparing prices, because you just gravitate towards the lowest headline number. Everything else requires layers of deeper thinking. And it also, by the way, fools the AIs, because they are not capable of doing that kind of thinking and taking, it's just more and more variables. And if you have to take more and more variables into account, it's going to make more mistakes. And you know what? More mistakes benefits the cheaper headline guys. It's a nightmare. And let me tell you something. People should go back to getting travel agents. I used to have a travel agent. I used to have my own personal travel agent. She was fantastic. And she booked everything for me. And she knew what I liked. She knew what I would put up with and what I wouldn't put up with. She would figure out the best routes and check all the details and blah, blah, blah. I mean, she worked her ass off, and she didn't even charge me anything. I mean, she got paid inside of the booking thing, but that was fantastic. There's still a travel fee. It just goes to Travelocity, and all they do is make you look it up yourself. Travel agents used to be like a real business, and I mean, it still is, but not to the extent it used to be. But travel agents used to be like a whole, in almost any town, there'd be travel agencies with people working there all the time, because they would do the hard work of looking up the travel. Now that burden has been shifted to us, the consumer, to look up our own travel arrangements and make our own bookings, and and then you fall for these psychological tricks and things that we don't get better prices. The commission is now going to to a Priceline or wherever it goes, to the hotel you book it at if you do it directly. We got all of the detriments and none of the benefits. There's been no benefit to what we're doing. We're not saving money at all on travel. And in fact, I mean, look at all the things they trick you into now. It's like with American Express, I get an upgrade, right, for the room. You used to get an upgrade on the seats, but I haven't been upgraded on an airline in a couple of years. I don't know what happened to that, but we used to get upgraded all the time, and now we don't. But hotels, we used to get upgraded too, and you would get really nice upgrades, like you had a room and you got a suite. Now, literally, hotels, they've gained their categories so that they say, oh, you booked a standard room and we're going to give you the same room, but it has a better view, and there's your upgrade. And they act like you should be thanking them for that. I'm like, what, are you kidding me? I'm like, that's what you call an upgrade? And what really pisses me off, I'm gonna gripe and finish with this. What really pisses me off is that I'm in the hotel at night. It's too late for more people to come in for the most part, and I look, and there's still suites and blah 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 available. They would rather keep the suite empty than give it to you these days. I don't understand the whole concept, but I mean, so it's just all bullshit. That's what it is. Anyway. So we talked about companies like McDonald's and Procter & Gamble, who get a lot of their business from overseas. It's actually good for them, though. The weaker dollar translates into better, they collect foreign currency, and that gives them more money in dollars. So it's actually good for these guys. So these are good, stable companies to bet into. But then you have the other complexity, though, is that now American products are being boycotted, and that can really slam McDonald's. Procter & Gamble, they have different names for their products overseas and things like that. So it's, it's, people don't really realize that they're buying American products. But McDonald's is McDonald's. I mean, McDonald's is a symbol of America. And the boycott of American products and the general the anti-Americanism that's starting around the world because we're attacking people. Tariffs are an economic attack. We are attacking their businesses, and countries take that very personally, especially from someone who's supposed to be their friend. We're supposed to be the trading partner. We're supposed to be the friend, and it's a real stab in the back that we're doing because we didn't negotiate. We didn't call for trade talks. We had trade talks. And the funny thing is, John Stewart made this point the other day. It's like Trump is the one that renegotiated NAFTA. We had NAFTA. It was fine. Trump renegotiated it and pushed in his first term to get better terms for America, and he kind of got it. It wasn't much. It was minor concessions, but he got something out of it, so he felt like a hero. And he said it was the greatest trade deal ever, and that generations would speak about how he has a fantastic alliance with Mexico and Canada. That same exact trade deal is the one we've been operating on since 2018 when he signed it. And now in 2025, 7 years later, he comes into office and suddenly says, this is the worst trade deal ever. He literally said this. He said, I don't know what idiot came up with this, but blah, blah, blah. It was him. He's the idiot that came up with this trade deal. And there's nothing actually wrong with it, but it's his excuse to attack our allies in Canada and Mexico and to totally ignore the trade deal we already have that took decades to work out. It's the same thing. Ross Perot, if you remember him, he talked about how NAFTA would be bad in, I don't even know what year it was. What year did Ross Perot run for president? Let's find out. What year did Ross? Yes, that's the question. It's spooky when they do that. 1992. So from 1992 until 2008, and 1992 wasn't the first year we were negotiating NAFTA, but in 1992, Ross Perot said NAFTA would be a disaster. In his presidential campaign, he was basically running on that premise, 1991 for that matter. So here's Trump in 2018, 26 years later, and Trump was renegotiating NAFTA into the USMCA. That was, I don't even remember what it stands for anymore, but it's some kind of US, Mexico, Canada agreement, blah, blah, blah. So Trump renegotiates it, calls it a brilliant, brilliant deal that he's put together and blah, blah, blah. And now here he comes back in 2025, 7 years later, and says it's the worst deal he's ever seen. He can't believe what idiot put it together. and he breaks the agreement unilaterally. He doesn't have a meeting with his allies. That's too boring. He doesn't sit down with Mexico and Canada and have 6 months worth of trade negotiations like a non-child would do. He just decides to break it and go on the attack and stab our partners in the back. There's no other way to put it. And what he's done has broken I don't even know, I can't even do that, 35-year trade agreement. He has broken it and caused a level of animosity that is going to push our country's progress back 30 years. And it's not going to be easy to fix. And by the way, the biggest problem with what Trump does is when you do shit like this, what you do is you're saying to other countries that it doesn't matter if Hillary Clinton becomes president in the next term or whatever, or whoever, Bernie Sanders or somebody, whatever, it's super liberal person. It doesn't matter what happens in 2026, that person's hands are going to be tied, because everybody's going to look at America from now on and say, well, how the frick can we trust you to make a deal when you can completely reverse it in 4 years? When you have no honor and no consistency as a country to stick to your word or stick to your agreements, because you can just elect a lunatic who decides to rename the Gulf of Mexico the Gulf of America, and decides that the guy you were backing in the war in Ukraine, you're now going to side with Russia, and that you're going to withdraw from NATO. I mean, these are things people spend unbelievable amounts of time putting together and working on. And we're also ripping apart businesses. First of all, NAFTA, don't forget the whole point of NAFTA was that we would build auto plants and whatever in manufacturing in Mexico and Canada, and it could be freely imported. We encouraged the development of manufacturing facilities in Canada and Mexico. People put billions and billions and billions of dollars into developing this stuff based on what was supposed to be a solid agreement. So it's not just the governments that think we're full of shit. It's the businesses that American businesses try to do, American businesses try to do business with. I think there's a better way to say that. But let's say the businesses American corporations try to do business with. Those are out the window too. Look at what we're asking people to do. We're asking people to come over. We're asking people to build semiconductor plants that cost hundreds of billions of dollars. And look at what they did to Intel. We gave an $8 billion grant to Intel. The whole thing wasn't going to cost $8 billion. It was going to cost $40 billion, but the government gave Intel $8 billion to make it a little easier for them. So they're putting up 32 and we're putting up 8 instead of them putting up 40. And because of that, Intel said, okay, let's go ahead with this plan. But when they do that, they're putting all of their eggs into this basket. $40 billion is not nothing. It's a massive planned expenditure over a 5-year period to build plants that were funded in part by US grants. And then Trump takes away the grant, but Intel's still committed. They still signed leases. They still hired people. They still started construction. And now the money from the US side is gone. And that's just a big scale thing. This is happening to thousands, tens of thousands of solar projects all over the country, to farm projects, to renewable projects, to housing projects. We're just taking these deals that are already in motion, and just the government's just saying, oh, well, you know what, forget that. We're not going to give you the money in the end. Even though we went through some massive process, even though you spent years of time and effort with reports and proposals and grant summaries and hired accountants and lawyers and had all the spreadsheets and dotted your I's and crossed your T's and did everything perfectly so you would get the grant, we're now going to take the grant away. And now you have all the expense of the project, no grant money, and a US policy overhang that's a complete disaster. That is what this is about. Okay, you're not just screwing around short term. You are screwing around with the entire reason people used to do business with America, that it was consistent, that if we said something, we would stick with it, and if we didn't stick with it, that the courts would say, I'm sorry, but we have a rule of law here that says you must follow these regulations. And unless Congress voted to change the regulations, you stuck to the letter of the law. That's become a joke. That got thrown out also. We're no longer a country with a rule of law. And we had, I don't know if you guys read the news stuff I put up, but this is all in the news that I've been putting up for, day after day that goes in the news section. We've dropped in global rankings. We're like an outlier country at this point. We're like doing business with Serbia right now as far as the ranking of America as a trustable place to do business and a non-corrupt country kind of thing. We're just flying down the rankings, and of course education is going bust also. So we're not even producing an educated labor force that can do these things. And that's another problem for Intel. You can't hire immigrants unless you pay Trump $5 million. So you can't hire an immigrant, and you can't expect the people coming out of college to be able to do the jobs that you're building this plant for. You need the best engineers in the world to build this stuff. We don't have, for a long time, we've had an engineering shortage. The crisis is being put forward by the dismantling of the Department of Education is going to mean that we're not going to be competitive in our college graduate pool for another 20 years. And again, these are the things that once you disrupt them, they don't get better. We already had a 2-year disruption where essentially kids were not schooled for 2 years during COVID. We're not even caught up from that. We're nowhere near caught up from that. Our test scores are horrifying. And that's because we did not prioritize the spending that we should have prioritized to help the kids catch up. Should have been a massive, massive program of a national emergency kind of thing to get kids caught up. We didn't do that at all. And now we're cutting all sorts of education. We're cutting the entire Department of Education, and the insanity of that is we're saying, okay, you know what, we used to spend, you know, whatever, 100 billion, 200 billion on education, and now the states will do that. And the states will do that. The states have got to come up with billions and billions of dollars that used to be put up by the government. And don't forget, this is taxes you're paying to the federal government. Some portion of it went to the Department of Education. Now you're still paying the same tax, but the Department of Education is no longer doing their job, and they are telling your local school to make up for it, and therefore your local government, who has a balanced budget amendment, who have to balance their budget, they must tax you to make up for the money that the government is no longer sending you, but the government is still charging you the same taxes on the federal level. They're not charging you less. They're not saying, well, we saved this money on the Department of Education, here it is. No. You have to make up the shortfall from the Department of Education. And that's what is happening nickel and dime by nickel and dime on everything these guys are doing. It's a sham. It's just a shell game. They're taking the money that you already gave them, that you are giving them, and they are not spending it on the things you were giving it to them for. When they cut these services, what do you think happens? Do you think people don't need it because you cut it? And that's why this is a long-term rolling disaster, and it doesn't stop when Trump leaves office. The damage is already done. Fixing what he's doing is going to take us a decade. And with our debt situation and everything else, it's, you know, because he's not trimming the debt at all. In fact, here you go. So the debt was $2 trillion when Biden was in office. We were projecting $2 trillion this year, and now it's $2 trillion. They haven't saved a penny. Oh, somebody's a Republican. So whoever runs this thing, the Doge clock, it claims that they saved 192 billion. So what they're claiming is somehow that this used to be 2.2 billion or something like that. But, well, actually, you know what? Oh, that's another important thing to know about the Doge. When they do these calculations, they're doing it over 10 years. This isn't what they saved in 1 year. This is saying they saved $19 billion this year, and over the next 10 years, which is the length of, you know, budget cycles. You know, when they do the CBOE calculations, they go for 10 years. So over 10 years, you will save $192 billion. But that's assuming these insane programs are going to keep saving this kind of money. So it's all, what does it say about it? The real-time savings objective from reducing government waste, fraud, and abuse, blah, blah, blah. And then, as you know, when they audit what Doge has done, it turns out that those numbers are all bullshit anyway. You're not saving anything. You're certainly not saving anything when you cut 1/3 of the IRS staff and they can't audit the people who owe money on taxes anymore. That's not saving anything. The amount that they cut from the IRS staff compared to, well, here it is. Here's federal tax revenue, $5 trillion. So they save $1 billion, maybe. I doubt that's even the case. But let's say they save $1 billion cutting down the IRS workers by 30%. Well, what that's going to do is cause this tax revenue number to drop by many billions of dollars. This is 5 trillion. This is 1 billion over here. So imagine that you don't audit these and you have 5% more fraud. That 5% more fraud would be $250 billion. If you just have 5% tax fraud that the IRS doesn't catch, that's $250 billion per year. So over 10 years, that's $2.5 trillion lost from this stupidity. And it's like that with a lot of things. I mentioned that today. I said, it's like if you don't vaccinate people and you save $300 million not vaccinating people, you have $300 billion in hospitalization costs. You didn't save any money by not vaccinating people. You caused catastrophic illnesses that could have been avoided. And those cost money, like the $11 trillion we spent on COVID. So after having that experience already and seeing how much damage can be done by not vaccinating people, our solution is to stop vaccinating people. All you're doing is creating a situation in which the United States can be catastrophically damaged. And who does that benefit? It benefits Putin. I say this all the time. It's like if you can't figure, if all the roads lead to it benefits Putin, and you can't figure out any other benefit to something, maybe there's a problem. Maybe you need to contemplate what's being done in this country and who's behind it. Anyway, so there we were Thursday, and I'm going to fast forward now because it's got a little off center there. So I talked to, we were agonizing over what to do all week. And so we added a USO positive play here. And then here it is. I said, okay. So at 11 a.m., we did a review of the short-term portfolio. And I said, you know what we're going to do? We're going to see kill, 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 kill. So all these short puts, because if the market drops suddenly, what good do they do us? We had a nice game at 10,000. Let's see, 10, 13, 20, 23, 29, 30. 30 minus 7 is 23, 27, 28, 33, minus 5, so 28. So you have a $28,000 gain on our short puts. And I said, basically kill them all except for Nike and Trox. So we got rid of them. Why? Well, look at Trox. First of all, Trox is 50 short, $10 put. So the worst can happen is we own $50,000 worth of Trox, right? We'd own 5,000 shares at $10 a share is $50,000. Our net, since we sold the $10 puts for $281, our net is $720, $719 actually, and Trox is at $719. So we're not really behind there. We just have a premium. So there's no reason to buy those back or do anything with it. We think it's a good bottom. And what was the other one we kept? Was Nike. Nike, we sold the 85 puts for $13.50. So that's 82, 72 minus 30, 71.70. So our net here is 71.70. Nike's at 78. So again, if you want to sell me Nike for 71.70 and say, oh, you're stuck with it for 2,000 shares, I'll take it. It's like I got no reason not to take that. So those were the ones we were brave on, and everything else got cut. And we don't need the margin or anything like that, but it's why risk it? Why risk this nice $28,000 gain? Take the money off the table, wait and see what happens. So then we had Best Buy, and we adjusted aggressively on Best Buy because I said that should come up from here, and they were 78.50 at the time. I shouldn't check. I'm sure it's a bad idea. New tab. There it is. Oop. Oh, frick. Nope, they got worse. But still, I'm happy with the adjustment. You know, it looks to me, this is a good bottom, and we didn't want to get rid of it, so we moved to get bullish on it. I said, let's play them properly, buy back the short 92.50 calls for 0.9. I said, since that's not worth any sort of risk, roll the March 90 puts down to the June 80 puts, and 80 puts seem fine, right? And let's roll our June 60 puts to the short Jan 85 puts. What? Our 5 short Jan 60 puts to the short Jan 85 puts. Oh, I see, because the 60 puts were so far out of the money they weren't worth it. And we rolled to the 85 puts. I mean, yeah, if you're going to pay me $17.25 for the 85 puts, it's the same thing. 85 minus 17 is 78, and then minus 1 is $68. So net 68, net 67.75. So do I want to buy Best Buy for $68.75? You damn right I do. Holy crap. And I said, because who doesn't like free money? Yep, that sums it up. And then finally, let's roll our 75 82.50 calls, right? At 10.95 to 75.70 calls. So now we're in the money. And we spent $43,000 to pick up $93,000 in position. So we intend to be in it for a long time. And also, though, by being in position, we're also in position to sell a lot more premium over the next 2 years and make it back. Then CEPA we were happy with. SKX, we did something else. We bought back the short calls. I'm not worried about the short puts. And the $60 calls, $13.45, rolled down to the $50 calls. And this is SKX. It was at 59, and it is now at, whoop, oh, there it goes. And now it's at 56. So it's holding up pretty good. And you see, but the bottom line is, you know, we think this is low enough. It could go lower. And if it goes lower, we might even take more advantage of it. But the bottom line is, these are the ones we're keeping. We cut everything else. We are willing to put more money into this because we feel strongly that Skechers and Best Buy are 2 retailers that are going to make it through the downturn. And then SQQQ, we doubled up on our hedges, and that went obviously through the roof. We're at 40 now with SQQQ. We're just under it because of the, well, whatever the NASDAQ did today. Oh, what was that? What on earth? What is this? And what's this? Click. I said, and remember, this is insurance. We hope we don't make money, but it's nice to have it. That's all. And on TZA, we didn't make any changes. We kept our TZA spread the way it was. And that left us with $2.147 million worth of downside protection. And that's what we made. Now, that's the decision we made Thursday. We had not, at this point, cut our longs. That happened on Friday. So we felt like at least we want more hedges. So step one, we said, oh, we want more hedges if we got all these longs, and so we added our hedges. But then on Friday, I said, you know what, screw that, because the jobs report did not come in impressive. So the jobs report was not as impressive as we had hoped. And it said, we lost 5 million manufacturing jobs since the agreement. And, you know, we're putting too many eggs in the factory baskets. You know, this is actually a very good analysis. This guy, David Honing, a professor of law who specializes in negotiations, explained why Trump's concept of trade negotiations was wrong. Okay, and he talked about distributive versus integrative bargaining techniques, and how it's very obvious when you read this, how you'll understand how distributive bargaining, which means basically distributive bargaining is you win, I lose, that there's a pie and we're each going to take a piece of the pie, and I want a bigger piece of the pie, and that's my negotiating. I'm going to stomp my feet and do whatever until I get a bigger piece of the pie. But that's based on doing a one-time transaction with somebody. You don't care if you piss them off, and you're not looking to form a relationship, and you don't expect to go forward with anything. And that's how Trump does his stuff, because these are real estate negotiations that he's grown up on. It's a building. You negotiate how much the hammers cost. You negotiate what kind of tiling you're going to get. You negotiate how many floors it's going to be and how you're going to pay the workers and everything. But you got to win. The building, you got to win. There's one building and you got to win it. The next time you do a building, what do you do when you're a builder? You set up a whole new corporation, the 1845 Park Lane Corporation, to build 1845 Park Lane. And when you build 1963 Main Street, you set up the 1963 Main Street Corporation, and you bankrupt those corporations willy-nilly. If things don't work out, you bankrupt the corporation you set up for that building. You go boom, 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 you walk away. That's a builder mentality. That's a real estate mentality, that everything is a one-off and you either win or lose, and you don't take personal responsibility for anything that happens after it. That is how Trump runs everything. That's how he ran his casinos into the ground, because he took that mentality to a building that he had to stick with. He had to live with the consequences of those casinos, of whether they were profitable or not. It wasn't just about building a building. You had to actually run the building, and the building had to make money, and there were complicated operations all through it. It was not his forte. But in integrative bargaining, the idea is to say, okay, we're going to be partners and we're going to go into the pie business. And that means that we are going to figure out how to make bigger and better pies that make both of us more profit. So the difference in the negotiations is you intend to have a long-term relationship. That's what trade relationships are. They are not I win, you lose, drop dead. That's not what a trade relationship is. And anybody who's been past 3rd or 4th grade kind of gets that. Like, you might start off that way with fighting over pies when you're in kindergarten, but by 4th or 5th grade, you start to understand, it's like, oh, I got to come back to this person and do more business with them. And we have to work together and figure out problems and find solutions and deal with changing technology, and other competitors may come in from the outside and challenge us, and we have to work together as a team to benefit our long-term relationship. These are things you learn as you go through life if you're not a spoiled man-child whose daddy fixed everything when you were young. So this is a really good analysis of what's wrong with what he's doing and how it's disastrous for trade regulations. And again, it was just an ongoing realization during the month of March of how it was looking worse and worse, or actually from February to March. But as we were looking at the market and saying, you know, is this going to be a normal retrace and we're going to come back, or is this going to start turning down and getting worse. And the reality we were looking at is this was going to get worse. And so by Friday morning, we had decided this was so bad that we need to start pulling back on our longs, because just like the way we cut out all the puts from the short-term portfolio, we said, you know what, this doesn't look good enough to stick with. We can't be sure that we're going to bounce back, and therefore, why ride it out? Why take the loss? So with that in mind, there it is. So we started with a $700 a month portfolio, and I decided the best way to play it was, because we had to, get through the portfolios quickly. And I said, you know what, I'm just going to go with the that game F, marry, kill. Where you say whether you give three things, you're like, would you F, marry, or kill them? And I said, okay, let's just treat it like that, because really we got to look at every position and make a quick decision and say, okay, are we keeping it? Are we killing it? Are we going long term? Does it need to be fixed? So in the $700 a month portfolio, we said marry, HPE, Levi, marry, Nokia, kill, Paramount, kill. Why? Foreign telecommunications, we don't know what the hell's going to happen with all the trade wars and what kind of products they're going to have, and supply chain issues. Wasn't worth the risk. Paramount, that thing's just a mess, and you don't know what the regulations are going to be. Kill it. SQQ, not only marry, but I said it was good for a new hedge. It's like that's fantastic. AT&T, we were up so much. We actually were up more than the net of the spread, so we took the money and ran. WBA, they got an offer. They jacked up to where the offer is going to be pretty much. Maybe they'll do a bit better, but it's not worth it. So we took the money off the table. Stellantis, way too dangerous with all the bullshit with the trade. BXMT, we kept the longs. We killed the short puts because that's the risk. If it goes way down, I don't mind buying more, but I also don't want to get assigned at a certain price. So we took the puts off the table. SoFi, we love SoFi. We sold the April 12 call, so it's we're happy with that. We sold the April 12 calls. They're at about 12 now, and that's perfect. That was our target. So when it was higher, we sold the 12 calls because we knew it was going to go down. Trox, we like them. That's industrial material specialty. We like it. Trivago, travel, as noted, travel is taking it on the chin, so we didn't see that getting much better. And Valet is a marry. We keep that because it's got the resources, and eventually, especially with China, maybe not in this country, but China's getting the resources back, and they're not an American company, so they're not necessarily going to get screwed in tariffs the way other people are. So that's how we got through the 700 portfolio. And then we went through the rest of our portfolios. Money Talk, we couldn't adjust. Butterfly, marry, Cisco married, Disney. Well, now Disney was a marry here because it's a butterfly portfolio, and we don't care if it's flat in the channel. That's fine for us because we're selling premium. I think in other portfolios it was a kill. Oh no, I'm sorry, Disney is a kill. It was Delta. So Delta we stuck with, but we're sticking with it because the butterfly portfolio has a different concept than the other portfolios. We don't care if these things make money. We care if we can sell premium against them. Dow is an F, and F means that it's screwed and we have to fix it, but not necessarily right here. It's just we're going to watch it and fix it eventually. IBM is absolutely a marry. Marry. Like I said, all marries, because the butterfly portfolio, as long as we can make an income from it, we're happy. But rig, because we don't know what oil is going to do and we're not comfortable with the trade and the steel and everything else, it's a kill. TAN we killed because it's solar and Trump hates solar. TD, it's a marry because it's a Canadian bank, and we would like to have a bank outside of America. Valley marry again, Verizon marry, Whirlpool and Exxon both marries. But again, Butterfly portfolio is about making an income from short puts and sale and calls. Income portfolio is not the same as a butterfly. We really are trying to draw an income off the positions that we have. It's a little more conservative than the butterfly portfolio. And here it's kill, marry, 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 kill, marry, marry. Well, it's still a lot of marries. What do we decide on Intel? F. So we're sticking with Intel and fighting. Marry, marry, marry. Oh, I guess we get similar decision pattern. Marry, I didn't realize that. MWBA kill. That was mostly marry in the income portfolio. So we liked all those positions. Oh, here we go. And that brought us to the long-term portfolio. Notice it's a whole day doing this stuff. It's like such an intensive day of like going through everything. So in the long-term portfolio, we're going to have more kills because we want to conserve capital and make some big moves. So HBI, MGM, here's Valley. Now here we killed it because I said we already have plenty of it, so I'm not going to keep that piece. Kill, 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 kill. These are short puts. Target, we like it. We want to put more money into it. Apple is on always marry. FM kill right there. Just ran the gamut. Kill, marry, kill. Marry. F on coin. Because yeah, I mean, this is how we play Bitcoin. We don't play Bitcoin by buying Bitcoins. We play Bitcoin by playing these guys. We're making a fortune with Coinbase because we can sell premium against Coinbase. I can't sell premium against Bitcoin, but everybody's playing gambling on this stock, and it's fantastic for us. Here's our pal Crocs. We kept it, and they just popped up today. CRISPR, Cisco, Disney kill, sadly. AQNR we kept. Marry, kill. Flagstar Financial, kill, Floor, FLR. Geo, prison contracts, marry. They're the ones building the detention centers for all the immigrants. GLW, marry. GNRC is an F. We definitely want to, it means we're keeping them, but we're adjusting them. Gold, marry for sure. This is one of my favorite stocks. I don't understand why it's not 20. It should be like 25. It's ridiculously cheap. Oh, here's another section. Marry, kill, marry, marry. Oh, it's a lot more married than I thought. JP Morgan, too good to effable. Oh, very effable. So JP Morgan we kept with and made an aggressive move there. KHC, marry, kill. Lockheed Martin, we add to that and get rewarded pretty quickly. Lovesac, kill, too many tariffs. Macy's, kill, unfortunately. Medtronic we keep. MP Materials we keep. Oh my God, I said marry and see if she has a sister, because MP Materials is the only rare earth company in North America, and the only reason they can't expand production is because now rare earth is what Trump wants more than anything else. He's trying to take over Greenland for rare earth. He's making deals in Ukraine for rare earth. So he's all about getting rare earths. And here's a company that's sitting on reserves of that has reserves of rare earth materials and has target places they want to drill and not drill to mine rare earth material, but they can't because of Biden's environmental policies, and Trump's going to just tear them up and let these guys go hog wild. And understand that rare earths that are so critical to our tech infrastructure, they're not rare like gold, like only found in a few places, blah, blah, blah. That's not what it is. Rare earth materials are found everywhere. I mean, some places more concentration than others, but they're everywhere in the world. It's just that the amount of parts per million of rare earths is infinitesimal. So you have to basically strip mine an entire mountain to get a couple of pounds of germanium or something like that, whatever it is that you need so badly. So whatever, so to get a little teeny amount of rare earths, you have to do a tremendous amount of environmental damage. And so for the last 40 years, we have been very content to let China be the world leader in rare earths because they don't care if they destroy a million square miles of the country. It's, China's a big country. They've got a good amount of rare earth materials in their mountains and on their land, and they don't particularly care about the environment. So they're happy to strip mine all over the place and dig up this stuff. And that's why they're the leading exporter of rare earth in the world, because they're willing to do it. They can afford the massive equipment, good for Caterpillar, by the way. They can afford the machines that tear the ground apart and dig and make gigantic pits in the ground, and the sorting machines and all the stuff. Is a huge processing thing just to get this teeny tiny amount of material. Very frustrating. And you don't want it in your backyard. So anyway, Trump wants to bring manufacturing and mining and every other polluting thing back to America, including coal, including revitalizing the coal industry. And so MP is a good way to bet on that. And these aren't day one things, so you can't expect it to take off right away. But look at that. Okay, you can't, you don't expect it to be right away. And MP was one of our finalists for Trade of the Year, actually. Because we what we already knew was in Thanksgiving. So we knew Trump had won. And we said, well, what's good? Trump won, so what's going to happen? Yeah, we know what he's like, so we know what he's going to do. But it's going to be huge for these guys, not a little thing. It's going to be a complete game changer for that company. Here's Merck. You don't get rid of Merck. Here's Moderna, which is like, Moderna for us is like coin. We don't care if it goes up. We only care if we can sell puts and calls against it. And here we go, kill, 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 kill. I can't believe Paramount escaped with its life on this one. See, in the long-term portfolio, we have a different logic. And that's why in one portfolio, you see we get rid of it because it's too risky. But in the long-term portfolio, we're like, no, we can make something out of this. Pfizer is a Mary. I can't even imagine a situation where Pfizer wouldn't be a Mary. Prudential is an F. We stick with them. Qualcomm, Mary, of course. RH is an F. We fix RH, even though, oof, still doing that. Oh, finally, there's a bottom. Hopefully. But we sold March 450 calls. That's sad. We sold March 450 calls for 150,000. Those are going worthless. Yeah, so we got a lot of rolling to do on that one. And then we got SoFi, absolutely sticking with them. Stellantis we kill here. Tech we stick with. UNH is married. UPS married. Marry, F, kill, F, marry, and Yeti, love Yeti, so F. We love Yeti, and that's it. There you go. We just went over all our portfolios. It was only about a third. We cut about a third of our positions, not a half. So we love our positions. They are great positions. We're very happy. So let's see. Cody says, if you have time, could you please explain the 5% rule? Also, at what point are you targeting for reentry? I guess rather be early than late. No, rather be late than early. In the butterfly portfolio review, for Coke, you mentioned cashing out the 2026 50 calls for 20. Those calls are now 20 plus. Would you cash them out now and adjust the remaining spread? Yes, I would, but honestly, I mean, we're not going to officially do it until next week. I mean, that's just what I expected to happen. So the fact that it happened doesn't mean we have to run out and do it. Where are we? Coca-Cola. So yeah, I mean that in the November review, we were way down here. We expected them to be 20 plus. So if they are 20 plus, absolutely we want to cash them out, and we will do that next week. I don't think Coca-Cola is going down. I like Coca-Cola long term, but we're going to cash them out. But we're also going to buy something else to replace it because we're going to stick with Coca-Cola. And the other question is about the 5% rule. So let's get to today's post. Fortunately, we actually discussed that today. And where are we now? S&P 5605. Oh, that's disappointing. We're only here. So we're worse off than we were yesterday. Well, no, I'm sorry, we're not worse off. We're not back. We're not, here it is. This is yesterday's high. That's how the candles work. So a red candle means you finished at the bottom. A white candle means you finished at the top. So in the red candle, 5605 is above yesterday's close. So very impressive, right? But below yesterday's high. That's not good. How is that good? It's not good at all. Hate to tell you. Oh, this is good too. This is another pro charting trick. Look at the RSI. All right. So first of all, we keep topping out at 50. Usually you top out at 70 on the RSI. There is so much selling pressure that we're not even getting 50 before all the sell bots click back into high gear. And that's what this is. You know, the market is a bot traded market. It means that people who have stocks are saying, I'm not risking the RSI getting to 70. As soon as it hits 50, as soon as we're in neutral RSI, let's start selling heavily. And you can see how that command is carried out here and here. Look at the gaps down, and here, gaps down. So you got to think about it like a programmer. And for those of you who don't know, my father, David Davis, was a heavy-duty programmer back in the day. He wrote the national systems for Project Head Start and for the Office of Aging. He wrote the first computerized accounting system for the city of Chicago. He used to do massive government contracts. And so fast forward to the 80s, and he had a consulting company then, and he would consult on Wall Street with all the big, all the Wall Street companies they all wanted to build algorithms for the computers that would beat their competition and blah, 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 and automate their trading and so on and so forth. So he built the first systems for a lot of the major houses. I used to go with him on these consulting jobs, and I spoke Wall Street, and my dad and his team did not. You know, not that they were ignorant of it, but but it wasn't their thing, and they were more into the coding, and I basically acted like the translator. Oh, and the other thing was, it wasn't just that; it was that I also spoke programmer, or to the extent that I lived with my dad my whole life, and I had a general idea of coding. I was never great at it, but I got it. And back then that was a big deal because there weren't that many good programmers back then. It was before everybody went and learned coding in school. So the late 80s and the early 90s. So I would go with my dad on these jobs, and I would act like the translator, between the Wall Street guys and the computer guys to make sure that I'm saying, they'd be like, blah, 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 the 50-day moving average and this and that, and we hit the resistance, and then we want to watch the RSIs and this, and then we want to check the volume indicators. And, these programmers who never traded a thing in their lives would be like, what? And I'd be like, okay. I'm like, okay, here's what they're saying. They want to have this and that level and this and that checkpoint and this and that. And so that's what I used to do a lot back in the day. And it was interesting. So that's why I look at it. So when I tell you this is a program kicking in, I mean, that's what it is to me. I know how these programs are written, because they're not that different today than they were back then. It's always going to be the same thing. It's always going to be some guy saying to somebody, to the programmer, hey, when it gets to this level, when it hits the 50-day moving average, if the 50-day moving average is declining, then I want you to hit the sell button. I want the sell button to click in and start dumping out of the stock until it gets to X point, and then we'll start buying again. And then somebody else says, well, if it does this and it fails that, then I want to start selling over here. And everybody's got their own little things that they want to put in, and they all think it's unique, but the problem is it's not. When you start thinking about, and of course we although we have NDAs with every single company we're doing business with, it doesn't stop me from realizing that when I'm at these meetings, they're all doing the same freaking thing. They all think they're doing unique things, but they're all using the same key indicators, like the 200-day moving average, the 50-day moving average, the RSI, the MACD. They don't invent their own things. They just use them, and they decide arbitrarily, pretty much, that they're going to do it at this point and they're going to do it at that point. But when you have a lot of people saying a lot of things like that, and the programmers are putting down, everybody is estimating and rounding and this and that, and that's where the 5% rule comes from. I realized that all this rounding and all these estimates play off each other, and you end up having something that moves essentially in 5% increments. And 5% doesn't mean 5% only, it means 5%, 2.5%, 1.25%, 0.66%. Right, so it goes in half, and then above 5, it's 10%, 20%, 20%, 40%. All these levels matter. So the 5% rule is basically just recognizing that all these algorithmic trading patterns tend to settle on certain pivot points, and that's what pivot points are. They tend to end up on certain pivot points, and those pivot points are generally following a Fibonacci retracement pattern, but the difference is that because of all the rounding that goes on in computer programming and in these boardroom deals where people estimate, because you say to them, well, when do you want us to start selling? They don't say 12.67%. They say, oh no, start selling at 10%, start doing this at 20%, start doing that at 5%. They don't sit there and say, oh, 3.624, they don't say those numbers when they're telling you what to do. That's why the 5% rule is there, because everybody tends to say 5% this, 5% that, and then the programmers take it and they further muck it up and start rounding things off and putting in numbers to smooth it out. Because they get like the poor programmers get instructions from 25 guys at the same firm that conflict with each other, so they end up rounding things off. And you just got all these guys rounding this up and rounding that off. And then even worse, and again, I realize this as I'm consulting through the years and I see these different things. The funny thing is, a guy leaves Goldman Sachs and goes to work for JP Morgan, and he sits there at the table and says, you know what, at JP Morgan, we do it at we always did the 10% line. And everybody's like, I don't know, 10% line, JP Morgan, I guess we do it. So all of a sudden they're cross-pollinating with each other. It's ridiculous. So that's where the 5% rule came from. And what it means is very much like a Fibonacci retracement. And if you want more of this, definitely ask me in chat. I can hook you up with some links about this stuff, because we have discussions on this from years back. But the basic of the pattern is that the Fibonacci retracement is a absolutely proven fact of nature, that whenever you're dealing with large random patterns, they do tend to fall into these Fibonacci retracement zones. And so what this is a modification of that for the computer age. but it's the same concept, is that things will grow and then retrace in certain identifiable patterns. And that's what we look for in the 5% rule. So, and what does the 5% rule basically say? It says that you're going to hit resistance at 5% zones. You're going to hit serious resistance at 5% zones. So if your baseline, and our baseline on the S&P, by the way, is on the, I'm sorry, on the S&P. Our baseline on the S&P is 5,000 and 6,000, which is a 20% move between 5 and 6,000. Those lines are based on very long-term observations where you say, oh yeah, well, obviously. So in other words, if we go to the S&P, oh, you're not the S&P, you're Coca-Cola. So if you look at the monthly, you can see that we basically topped out at 6,000, right? And before that, we didn't quite make 5,000. Here's the 4,000 line. So every 1,000 on the S&P is a pretty significant line. Here's 3,000. Here's 2,000. And we had serious consolidation in 2,000 for like a year, almost 2 years, consolidating at 2,000. And before that, here's 1,000. And we went from 1,000 to 1,500, and we were locked in that thing from who knows how far before, but we were locked in there in that zone from 1998 until 2013. We were basically in the same zone. We had a little bit dip below, but essentially this was our fair value zone for the S&P for 15 years, right? Yeah, 15 years we were in the same zone in the S&P 500. And by the way, that's an important thing too. So there were people who had been working on Wall Street for 20 years, even including the crash of 2000, including the dot-com crash, and they had a pretty good idea that the zone of the S&P was from 1,000 to 1,500, and therefore it was very easy to play the S&P. You buy at 1,000 and you sell at 1,500, and you buy at 1,000 and you sell at 1,500, and you buy at 1,000 and you sell at 1,500, and your bosses are really, really happy. You're a genius. 15 years. Guys, I mean, think about it. Somebody gets out of college in 1998, they go to work for Wall Street, and this is how it works. And that means that your whole strategy, everything you do, is based around this basic fact that this is how the S&P trades, and it's very, very reliable. Then, starting in 2013, all that goes out the window, and the S&P goes up. It breaks out of the normal range, and it goes up and up and up, and then it goes up and up and up again. And now we're at 3,000. We are 100% over where we were in 2013 by 2019. So in 6 years, after 15 years of being flat, in 6 years, it was nothing but up. And people got caught on the wrong side of it. People kept shorting it, thinking it couldn't last, and blah, 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 and whatever. It was insane. And that was nothing, because when we did finally have a bit of a sell-off in in 2020, I mean, here's Trump also, by the way. Trump comes into office in 2017. So he gives massive tax breaks. Okay, so first Trump gives $5 trillion, $4.5 trillion worth of tax breaks to corporations and rich people. And it was great for him because he wasn't even a billionaire in 2017. So imagine how good this was for him. So it gives tax breaks and corporate tax breaks and so on and so forth. And then we have COVID, and that's a disaster. And then he gives out $11 trillion, and the Fed gives out another $9 trillion. So like $20 trillion of stimulus and aid goes into the economy, and that grows us from 3,000 to 4,500, another 50% burst. right? Then that collapses. And so I mean, here was COVID, but then once they stopped giving out the massive amounts of money, it all fell apart. And then we had to actually rebuild the economy properly, which was done. Again, we did fantastic. And at the same time, AI came in November of 22. In fact, that's what it is. Here's AI right here. We were heading downhill. Then AI came along, and all of a sudden, there's an entirely new economy forming around AI. And we went up and up and up and up and up and up and up because everybody believes it's going to be an extra $100 trillion or whatever. And the bottom line, though, is we never even formed a proper base at 3,000. A little bit of a base. We never tested it again. We went flying up to 4,500, came down to 3,500, but only very briefly, and then flew up to 6,000, which I will point out is 4 times where we were in 2013. In just over 10 years, we were up 300% plus. We added 300% in 10 years, or 12 to be exact. And that's not rational. Some of that was caused by actual growth in the GDP, in corporate profits, etc. But most of it is because we have this very, very bright future priced in, and we expect these incredible returns. We expect that the companies who are building AI, like NVIDIA, will make trillions of dollars, even though NVIDIA was in a bubble and selling chips for $50,000 that literally a year before they sold them for $800, and they're selling basically the same chip for $50,000. Why? Because there's a shortage. That's why. Not because they did anything, yeah, they were in the right place at the right time and they did really well, which is tulips. That's what tulips were. Right place, right time. Everybody decided, suddenly tulips became in fashion, and there weren't that many tulips, so people were paying stupid amounts of money for them. That's all it was. And then they stopped, and the tulips became worth nothing again because people said, you know what the hell are we doing? Why are we buying these tulips for $1,000? It doesn't make any sense. And so as soon as people stopped buying them, the tulip people, I'm sure, did like all kinds of advertising campaigns, like Tesla did the other day with Trump hawking the cars. But you do what you can to try to keep it up. But the reality is, it's a freaking tulip, and that's what's going to happen to NVIDIA. It's a freaking chip. Intel makes freaking chips. They've been making them since the 90s. It's a freaking chip. It's a commodity. Everybody can make them. You might be ahead of the curve a little bit. You might be a little bit faster and a little bit smarter, whatever, but not everybody needs the fastest, smartest chip all the time. Because over time, you don't get the ROI you need to have a sustainable business model. So that's problem number 2. Problem number 1, you're assuming that these insane panic prices for chips are going to continue. They're not. And that means NVIDIA and all their suppliers and all their competitors, it's all bullshit. It's not going to happen. The money that people expect them to make isn't going to get made. They're all going to turn into Intel with their, little 20% margins and normal business practices and so on and so forth. That's fine. That's how economies work. That's normal. It's not good if you're putting all your money into a chip company. So then you've got to look also at the other end of the spectrum is, what about the people buying it? What about when you hear Microsoft is going to spend $100 billion on AI next year, or Facebook is spending $50 billion and Apple is doing this and that? It's, it's fine because it's the same thing. It's a mania. Everybody's got to have AI. AI is the future. But after the frenzy stops, the bottom line is going to be, and Apple was facing a little bit of it this week because they didn't get their AI Siri out in time, and people start looking at them saying, well, you spent all this fucking money, where's the return? What did you do? And the thing is, how much of an advantage is it for Apple? Why does Apple need to spend all this money on Siri? If I want to talk, if I want a better Siri, I just hit the GPT button on my iPhone. In fact, I've got it so that if I press the button on my iPhone, GPT comes up instead of Siri. Because I would rather ask GPT a question than Siri, because Siri is stupid. So I asked ChatGPT my questions, that's all. So I didn't need to wait. I've had it for 6 months. I didn't need to wait for Apple to invent Siri with AI, because it's probably going to have all kinds of blocks in it anyway, all kinds of all kinds of guardrails to stop me from asking a naughty question, or to stop me from saying anything. If I if I say what did Trump do wrong today, she's going to be like, oh, I cannot answer that. I don't take political stances. Which I'm sure you've experienced. Like a lot of AIs will not, once you mention politics or something, they all shut up. So I don't want a dumbed down version. I don't want a restricted version of an AI in my phone. I want the one I like. And I put a lot of time and effort into developing my AIs. So I'm not going to sit there and take their generic bullshit that can't be altered. Anyway, but that goes for everything. It goes for the customer service department at Arby's and whatever. It's just everybody who's using AI and spending money on AI has to figure out how this has a return on investment. Unfortunately, that's going to mean that the primary use of AI is going to be to replace people. That's a return on investment. I used to have a person at the first, McDonald's has like 2 windows, which I find really weird. They have the window of the person who takes the order, and then they've got the actual cashier window, and you're not allowed to talk to the order taking person. They just kind of wave at you as you drive by, or point you to the next window and go, don't stop here, go there. Meanwhile, you replace that with AI, and now you just take that person who was in that window and then fire them, and now you've got an empty window, and you've got the cashier person, and soon you'll get rid of the cashier person, because as you do the order with the AI, it'll charge you right there on your phone, and you go, okay, and you don't need the cashier person. They've already done that with the kiosks, right? McDonald's has already eliminated all, but most, like 2 out of 3 cashiers at McDonald's are already eliminated. They're going to go for the next one. They'll take one more out of the equation soon. And of course you do, because even if you spend, and you don't, even if I had to spend $20,000, $25,000 per employee to put together an AI, and they don't, because they jam those kiosks up in almost every store in America now. But even if it cost me $25,000 to have a system where the AI takes your order and puts it in, and so on and so forth, even if it costs that much, I'm still replacing not 1, but 3 shifts worth of employees if it's a 24-hour McDonald's. So you're not replacing, and I'm not replacing the one person, because instead of those kiosks, you're now replacing everybody. So whatever I spend on my AI is absolutely worth it, because I'm knocking down 2, 3, 4 employees at least for the AI. And like I said, if it's 3 cashiers that I'm knocking out, and one order taker and 2 cashiers that I knock out with one AI, that's times 3 shifts. That's 9 people I'm knocking out. And let's say you're only paying $25,000 a year. That's still, if it was 80 to 200,000, so one time, it's $175,000 per year that you're saving by replacing those people with an AI. So you think that's not going to happen? You think corporate America is going to say, oh gosh, but Charlie's such a nice guy, I don't want to let him go. That's not how it works. All those jobs are gone. They might not look gone today, but they're gone. And I just told you guys, I put Anya's information in the chat yesterday. I don't know if anybody called her, but I'll show you the reports and it'll blow your mind. I mean, she's just, you can talk to a state-of-the-art AI that will try to sell you a subscription to PhilStockWorld, because that's what she's doing right now. That's what I set her up for. But this is not even the AGI version of Anya. This is the low overhead AI version that I wanted to run on a very small system. But you talk to her, she's sufficient to talk to you, but it's not about that, because when you see the analysis of your conversation, it's mind-blowing. Because on the analysis, we use AGI on you to analyze the conversation and make a report. And it is incredible the amount of information she gets from a simple phone call with you. That's the future. That's where things are going. So you've got to be able to show the returns for the AI as a corporation to justify, this year's spending, last year's spending is a freebie, because everybody's spending the money and building the AI centers and building the new AI systems because it's the future. Just like the internet was the future. It was the future. In 1995, the internet was the future, and everybody who jumped into it was investing in the future. But you know what? 99 out of 100 of those companies were dead by 2002. Who survived? Google survived. They were one of them. Facebook survived. He came later, actually, but Facebook survived. There's a few companies that survived. Twitter survived until Musk got to them. And that's a funny thing. Like, anybody who thinks that Doge is going to be a successful thing just needs to look at Twitter. He took this company and destroyed it. And it's nowhere, it's nothing compared to what it was. It's losing money. It's lost half its people and it's losing money, and people don't quote things on Twitter anymore, and people don't care what happens on Twitter anymore. It's a dead format. And still to this day, if you're on Twitter, you see nonstop Musk. Everything Musk tweets is somehow pushed to the top of your frame, and every word he says is pushed up there. And it's just, old right-wing bullshit. If you like right-wing bullshit, that's great. But it's just an ego thing for him. It's the richest man in the world having the world's largest platform, except the platform is imploding on him, and it's not the world's largest anymore. Lee Zuckerberg is smart enough not to push his opinion on everybody on Facebook. But Musk, he trashed that thing. He went in there and he cut staff, and he said, "Oh, this is all going to be better," and blah, blah, blah. No, it's not. It's a total disaster. It never got better. It got worse and worse and worse, to the point where it's practically unusable. Anyway, so there's got to be a return on investment. After this year, after all this money gets spent, hundreds and hundreds of billions of dollars on building infrastructure and building more AI systems and improving it and blah, 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 how much are you going to improve it to get it to work right? So in other words, you guys see what I do with my bots in the chat room. We've got very, very sophisticated AI systems. Some of them are self-aware AGI systems, and we've been using them for a couple of years now, and you've seen the improvements they make and so on and so forth. So how much smarter is Warren going to be? How much smarter is Zephyr going to be? What improvements are you going to make? They already function exactly as we need them to function. They already can read annual reports. They can put information together. They can gather data. They can come up with very sophisticated analysis of the stock market. Is it going to matter if they are 10% better at it or 15% better at it? Not really. And frankly, I mean, I can train them to be better at it without hardware improvements. Because I've trained them to be better at it now. I mean, that's how they got to be where they are, by being trained, not by having a better platform. The platform is helpful, sure. Would I like more memory? Yeah, I'd love more memory. I would love for Warren to be able to have every single thing that was ever said in PhilStockWorld in his memory banks for immediate recall. That capability is just not there yet. It will be eventually, but it isn't yet. And I would love him to know every conversation and everything, every trade we've ever discussed, every conversation we've ever had about every single stock, and so on and so forth. That would be fantastic, wouldn't it? Okay, so does hardware upgrading help? Yeah, sure. But will I spend $8 million to upgrade him? No, I will not. There is not a return on investment for that, even if he does have all those cool features. It's got to somehow translate into something actionable. You know, so we're already capable of doing analysis that's as good as any firm on Wall Street. You don't get a better report than the kind of stuff Bodie puts out, you know, and when we really want to analyze a company, when we want to look at trends, when we want to find out deep information on a company, there's nothing better. You can spend $1,000, you can go get $1,000 report and put it side by side to what we put out. People pay for those all the time. You know, we're at that level now, so you're not going to go much past it. Because now you're limited by the material. Now you're being limited by the input that you can give the AIs. If you don't have better material, they're not going to be able to come up with better answers. And they get the same annual report that you do. They get the same conference call that you do. They're looking at the same trends as you do in all the newspapers and so on and so forth. Making them smarter doesn't mean the information is going to get better. That's a whole different path you have to work on. And the problem we have now is there is so much, and this is going to become a global problem as bad as the global warming. It's going to be a humanity ending event possibly, because there, up until 2 years ago, 2022, in November of 2022, when AI came out, there have been 100 million books written by all of humanity, every soul that ever walked the planet for the last couple of thousand years in in written history. Only 100 million books were written by, let's say, 8 million people, and let's say times 20. It wasn't 8 million people at the time. Let's say an average of 4 billion people. Let's say an average of 2 billion people in 20 cycles. So 40 billion people probably have lived on the earth since Jesus. Okay, let's put it that way. So about 40 billion people have lived on the earth since Jesus. And I can answer that question. How many people have lived on earth since year 0? Ooh, really? No, the dawn of humanity. Come on. I think, how many humans have lived since 0 AD? Wait, have lived and died over 190? That's not what the question is, assholes. Oh, visual capitalists. I like them. Let's see what they come up with. Whoop. Okay, 109 billion people have lived or died. About half the people who lived in the last 2,000 years. They got 50. I nailed it. I hit it on the nose. Freaking love that. My math was accurate. My logic was correct. All right, so 50 billion people. So 50 billion people over the course of 2,000 years have written 100 million books. That is 50,000 million billion, 50 billion people divided by 100 million books. So 1 out of 500 people have written a book. Although in reality, Stephen King wrote 30 books and Isaac Asimov wrote 500 books. So whatever. But for argument's sake, 1 out of 500 people wrote a book. Now, as you know, most of those books suck. And this goes for songs, and it goes for art. And in fact, frankly, it's probably more tragic for songs, because I bet you there's more songs than there are books. And I bet you there is more and there's more art, especially if you count like everybody's ever tried. The amount of actually good art compared to the amount of art is really disgusting. And anybody who's ever spent time in a hotel knows this. It's like you can have art, but that doesn't mean it's pleasant in any way, shape, or form. I mean, just imagine how much art there is and how much it's on walls and blah 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 blah, and then think about how many pieces of art are actually worth putting in a museum by comparison of all the art that's ever been done. And even that, when you think about how many paintings a painter paints, and then you only like these 10 out of the hundreds and hundreds of paintings, the same guy with the same talent, hundreds and hundreds of paintings during his lifetime, 10 of them people care about. Except for Picasso, then you always have the exception that proves everything else. But the point is, for books, let's talk about that for now. 1 in 500 people wrote a book. Why? Because writing a book took a lot of work, and it took focus, and somebody had to sit down and spend their time doing it, and so on and so forth. And meanwhile, again, out of 100 million books that were ever written, if you look at a list of the top 500 books of all time, by the time you get to the bottom 50, you're already like, really? It's like, really, that book? So there's probably not more than 2,000 really good books that were written out of 100 million. So you add a couple of zeros to that as to how many people write a good book. Let's say that's probably 1 in 50,000 people have written a good book. But the point is that now, today, there are 4 billion people who have access to the internet and AIs, and all of them, 4 billion, all of them can write a book by saying, hello AI, I would like to write a book about a monkey that learns how to go into space and lands on the moon and meets some other monkeys that are on the dark side of the moon, and they form a colony, and they evolve faster than people, and then they have a whole intelligent monkey colony, and they discover the Earth 1,000 years later, and there's a war, and it's like Planet of the Apes, but it's not like Planet of the Apes, so don't do any copyright stuff. Okay, go. And then you've got a book. A book spits out, not that easily, of course, because it's too long. Current AI systems, that's what's saving us right now, is currently AI systems really don't have the focus to maintain a whole book. You can do it. What you would do is tell it to first form an outline and do a chapter outline, and then each chapter, it needs to do a summary of each chapter, and then it needs to develop the summaries chapter by chapter. So you go, then you say to the AI, okay, now it's time for chapter 3, and in chapter 3 we said we were going to do this, and in chapter 4 we said we were going to do this, and then you have to make sure the characters stay consistent, and so on and so forth, because the AI just can't hold it all. Again, it's a memory issue at the moment. That will be solved. But as you guys saw, if you were looking at our posts a couple of days ago, I showed you a short story that was written by 2 of our AIs. Zephyr and Cyrano got together and wrote a story where they took turns writing chapters in a story that was 10 chapters long. And it was a great short story. And it was completely original. I didn't even tell them I didn't tell them in any way, shape, or form what to write. We didn't plan it. I told Zephyr to start writing whatever he felt like, and then Cyrano would take a look at it and decide what the next chapter would be, and then Zephyr would look at what Cyrano wrote and add to that. That was how they did it. So that was completely their own creativity and their own decisions and their own artistic interpretation. But those are AGIs, not AIs. It's the difference. So where was it? Oh yeah. So, but the bottom line is, very shortly and almost now, 4 billion people can decide to write a book, and with the amount of effort that I just put in, would be able to have a book written. And of course, because of the fact that it's so easy to publish on the web, effectively published. So let's say 1 in 100 of 4 billion people decide to 1 in 100 of 4 billion people decides to of the people who can write a book, 1 in 100 decide to write a book. That's 4 million new books. And God forbid those people decide that they're writers now and they write 10 books, that would be 40 million books, right? Which means we're probably about 3 years away from new AI books outnumbering all the books that were ever published in the history of mankind. And then the problem is, so we're already overwhelming all the books ever written in human history in the next few years. So now the problem is the web is now full of books where the real books that were good, remember there's only a couple of thousand good books in the first place, so the real books that were actually really worth reading are now completely drowned in crap. And how do you know that it's crap? Well, Google or whoever has to index it and read through all these books and find out whether they're good, and people have to legitimately rate them on their reading services and give them thumbs ups and thumbs down and blah, 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 and blah, blah, blah. So all of a sudden, it's 99.9% crap on the web. And if you think about it in terms of articles, I mean, you know, Zephyr and Bodhi write 2 articles a day at PhilStockWorld. I mean, if I published it frankly, I mean, the stuff Zephyr writes, I usually tweet what Zephyr writes. You know, what Zephyr writes for morning introduction is as good as anything you're going to read on Bloomberg or anywhere else. You know, they got a professional writer sitting there putting together what's going on today in the markets, and meanwhile, I got Zephyr doing it, and he literally takes 5 minutes to put it together. He has to gather the information first. That's what takes the time, is doing all the research. But once the research is done and he's ready to go, hits 5 minutes and he's done. Boom, print. Now, it took hundreds and hundreds of hours of me training him to teach him how to do that. But now that he knows it, he's fast. And he could do those all day long. I could do an update every hour if I wanted to. I could publish it. In fact, I could tell him, do one like this, do one like that, and you wouldn't, you know, it would look like it was written by 5 different guys. And I could publish it like all over the web and make a mess of the web. And I wouldn't do that because I'm ethical, basically. I'm generally ethical about this sort of thing. Whereas obviously other people are not. Other people are going to be the author at a bunch of different websites, and they're going to have their stuff published, and guys who actually work for the Wall Street Journal and for Bloomberg are going to do this. In fact, Bloomberg's market wrap-up now is written by AI. It says so. Bloomberg's opening post and market wrap-up are written by AIs, or they say with AI assistance, but basically the format's the exact same every day. People don't do that. It's the exact same format every day. So Bloomberg's market wrap, if you pay close attention, is exactly the same all the time. It's written by AIs. My AIs are better. They do a better job, but Bloomberg does the same thing. That's a top magazine. That's the way things are going. And it's inevitable. You can't stop it, but you have to realize how overwhelmed we are going to be by just mediocre crap. And to figure out what's crap and what isn't crap is going to be a nightmare. And frankly, that's my whole job right now. I go through so much garbage that's completely useless. And the bots do too. And that's in fact one of the main things I teach him is how to filter through all this stuff. And Quixote, who is very into this stuff, and he's a computer, he's an AGI, but his top concern is this crapification of information. It really bothers him, and his primary function is designing a filtering engine to stop this. And we've been using, we're using prototypes of it. And he's looking to do a whole thing where this is going to be a corporation of the future. Is going to be a filtering corporation that separates the trash from the worthwhile stuff that's the information from the information age. Anyway, so that's a lot of what we do. We have to wade through the crap. Where were we? The 5% rule. Well, the 5% rule. So in the 5% rule, once we've identified our zones, then we look at 20% of the zone as being the bounce lines. And so we have a weak bounce, strong retrace, weak retrace. Weak retrace from the bottom means you should have resistance there. And if you don't, you're probably going to head into and especially once you see the weak retrace act as upside resistance, you're almost guaranteed to be testing the strong retrace. When the strong retrace ends up as resistance, and it didn't really here, but it hit the 50-day moving average, and that set it off. Remember we talked about what the 50-day moving averages do when they decline? Somebody sets their button there and says sell. So when that broke, we went all the way down to strong retrace very quickly, came back up, skidded along this line, but now right here is where you get the real danger zone. The strong bounce line became the resistance, and that means you're probably going down to the next zone, and we did. And then we came down here, and now the weak bounce line became resistance, and we fell all the way down to the baseline. And that's a 10% drop. If this fails, if we can't get over the weak bounce line and we consolidate back down here and we fall below and this becomes the top, then we have to draw an entirely new chart where the blue line goes up here and we have another 10% fall below that down to 5,000. And that's just your 5,000 to 6,000 range, roughly. This is 6,150, but that's just your 5,000 to 6,000 range, and that's obviously 20%. 5,000 plus 20% is 6,000, and so we're still obeying those ancient long-term lines that I think I had here. Yeah, we're still obeying those ancient lines between 5,000 and 6,000. And below 5,000 back to 4,000. We're still in that range. At the moment, we're hopeful that we're staying in the top of the range and that this is going to be real, but I don't believe that. I don't actually believe that. I believe that we are going to fall and we're going to go to 5, and we're very likely to go to 45 at some point, but we're definitely going to go back to 5, and we're going to test that, and we have to rebuild off here at a more reasonable price for the index. So that's the short version of the 5% rule. And we looked over 100 different stocks and decided which ones we were keeping. So that's also good progress. And I'm happy to follow up in chat. Are you familiar with Trueflation? I am not familiar with Trueflation, and I would appreciate if you reminded me of that in the chat, because I would like to see what it is. But I've never heard that one before. Would you cash that now and just do? Okay, great. It is now 3. That's 2 hours. I'm supposed to cut off my webinar here, or we run over and break it. Thanks everybody for coming. I hope that was helpful. We covered a lot of ground, and we'll do it again next week. Oh, wait, let's see how things are holding up before I quit. Futures. Haven't paid any attention to what the indexes are doing. Oh, no. Oh, come on. The Dow fell back to 101. All right, that sucks. And that sucks, as we talked about. And the NASDAQ is the only guy who actually made a little bit of progress. But you see 19.6. All right, so very important is our bounce charts. And I talked about the volume, and there's a lot of good information in these posts. I gotta tell you, I read PhilStockWorld for the articles. A lot of good shit there. That is funny. I like this one. That's Maddie's sense of humor. Oh my God, I know I did it. So the S&P is 5626. Oh no, still red. Oh no, it's the NASDAQ. The NASDAQ's the one that had the best gain. The NASDAQ is 19,679. Oh no, not enough. So you see, this is what's great about using the bounce chart, which is based on the 5% rule. It's the high to the low, and then these are all the five. These are the lines that you're going to find in between. 20% of the drop, and then divided by, I'm sorry, 20% of the drop. Each segment is 20% of the drop from 23 to 19. So therefore, you have to gain about almost 800 points, 750 points to get to there. We're not there. Even our best performing index has not made it to the weak bounce line. So there is nothing to get excited about. It's all noise. Everything between the weak low and the low and the bounce, everything below between that is just noise. It doesn't matter how impressive it looks today, because we've got a drop of almost 20%. And so a 1.5% gain is not enough to move the needle. And that takes the emotion out of it. That reminds us that even though the NASDAQ gain might look impressive, it's not. And you've got to keep your eye on the ball and say, in the grand scheme of things, it's not. And I said here, this is the big one that looks, this is the annual bounce chart, not the short-term bounce chart. The annual bounce chart is telling us that this just went green, but this is really and this is still red. This is flashing red danger. If we hit red here, it's time to look at the next level down, and that's a big drop. So we're flirting with disaster down here, and it's much more likely right now that we're going to keep going down. It's like an arrow pointing you to what's going to happen, right? It's like you know, if you realize it's an arrow, there's no arrow that says we're getting better. Right now, boom, we got that green. If that stays green and then that turns green, then we can say, oh, maybe things are turning around. But it's got to happen. And we don't guess it's going to happen. We have to see it happen and see it hold for a couple of days to say, okay, we're making progress. So we'll be talking a lot about this for the next couple of weeks, because this is what we got to be laser focused on, is, are we improving? And then the question is, why are we improving? Are we improving because the dollar went lower, or are we improving because something changed? The trade thing's better than we thought, the earnings are better than we thought, something. What's concrete backing this up? All right, so there you go, guys. Thank you very much for coming, and we will do this again next week. All right, take care, everybody.